What is a testamentary trust? A testamentary trust is a trust established under a person's will. The assets that form part of that trust are from the estate of a deceased person. Instead of leaving inheritance directly to a beneficiary, a will can direct that, in some cases, the inheritance is to be distributed to the trustee of a testamentary trust. The beneficiaries of the trust are the intended beneficiary, who is often the primary beneficiary of that trust, and that beneficiaries' family members, such as their children. The terms of a testamentary trust can be restrictive or flexible, subject to the testator's intentions and whether the intended beneficiary has any vulnerabilities. Testamentary trusts offer a range of advantages that can really benefit families. They can provide asset protection, help manage tax more efficiently, and allow for greater control over how and when assets are distributed. For families with young children, beneficiaries with special needs, or even just for peace of mind. Testamentary trusts can be a smart and flexible way to ensure your wishes are carried out and your loved ones are looked after. There are two main advantages of the testamentary trust and, reasons why they are a common structure utilized during the estate planning process. The first main advantage is the tax planning benefits and the potential to save significant amounts of tax for a primary beneficiary's family. The income earned from the assets held in the trust can be distributed to one or more of the beneficiaries or potential beneficiaries in a tax-effective manner, for example, to those on the lowest income. The trustee has the discretionary power to allocate income and capital as the trustee sees fit between beneficiaries, which can result in considerable and continuing annual tax savings for the primary beneficiary in managing their inheritance following the death of the testator. Further, distributions to minor beneficiaries are usually taxed at normal rates, which is not usually the case for distributions to minors from other types of trusts. The second main advantage is a level of asset protection. As the assets are not held in the personal name of the primary beneficiary, having the assets held in the trust offers a measure of asset protection against loss through divorce, bankruptcy, or incapacity. The level of protection that can be achieved is subject to a number of factors, including the nature of the risk, the involvement of the primary beneficiary with the control of the trust, and how the assets of the trust have been managed and distributed. If you need more information or would like to discuss your specific situation, it's important to reach out to a qualified legal professional. We're here to help you navigate the complexities of wills and estates with expert guidance and support. For any assistance, please contact MJM Lawyers, your trusted New South Wales wills and estate lawyers led by our founder, Michaela Money, who became a solicitor in 1998 and has been an accredited specialist in wills and estates since 2009. Visit www.mjmlawyers.com.au to book an appointment or call +6 102 808 93139. With a wealth of experience, Michaela Money and the team are here to guide you with confidence. Liability limited by a scheme approved under professional standards legislation. Disclaimer. This post contains information of a general nature only and is not intended to be used as advice in relation to a specific matter. Although every care has been taken in preparing the document, it may not be accurate or complete, particularly in the context of specific circumstances. MJM Lawyers disclaims responsibility for any errors or omissions.